thank you everyone for joining another session of Real Estate Accredited. A little bit of a different format tonight because both Jeff and Rajiv are busy doing they had other commitments. So it's only me tonight. So I'll do my best to answer questions, let people come in and so on. As usual, welcome for the first timers. Welcome back to people who attended a prior call. Our goal here is to talk about multifamily real estate and to do both some education and networking. So the first part of this call is going to be about teaching and going over a topic. Tonight, actually, it's going to be the passive investor point of view and also going over worst case scenarios from a passive investor point of view. Feel free to ask any question you may have during the presentation. It shouldn't be, I don't expect it to be much longer than 20 minutes. But yeah, ask any question you may have. You can unmute yourself, ask the question, or type it in a chat. I'll keep an eye on that as well. And after that, we'll do a little bit of networking. And that's going to be it. All right. Tonight, passive investor point of view and worst case scenarios. As usual, in Real Estate Accredited, what we want to achieve is help people who are joining us to have a better understanding of investing in commercial real estate, particularly in-place commercial multifamily value add. And again, today, passive investor point of view, worst case scenarios. So I think from a passive investor point of view, those are the things I would say, for a passive investor to consider investing in commercial real estate passively. Again, I'm repeating myself, but that's the idea here is why even consider that avenue? And just so the first bullet point here, the capital deployment, I think it's two sides of the coin. One, in order for sponsors to purchase larger properties, you're going to pool investors' money together in a syndication, which is the SEC term for bringing those funds together. And doing that as a group, you'll be able to acquire larger, bigger properties, and you'll be able to achieve economies of scales and therefore also diversifying a little bit your risk, which actually that's the next point. So perfect segue. Why you want to do that is because you're going to diversify your risk. And how you achieve that, the idea is instead of buying a single asset and putting more of your investments in a single place, you can easily diversify your investments in different properties, in different markets. But in addition, going on the risk side, you're spreading out the risk among multiple units. So now your risk of what's the consequence of having a vacant unit is going to be lesser to have a vacant unit out of 50 compared to have a vacant unit if you own 5, let's say. And at the end of the day, you will have invested the same amount of money in both assets. Your risk is going to decrease there. And as I mentioned, you can easily invest in multiple properties in multiple markets, therefore achieving diversification. But I would also say investing in real estate, it's a way to diversify your investments. You may be heavily invested in the stock market, for instance. So the next third bullet point here, the professional management. And here what we mean by that is you're going to have a sponsor, an experienced sponsor that is going to take care of finding the deal, underwriting the deal, finding the right loan, the right financing for the deal, and then bring the capital together. And you want to consider sponsors with a lot of experience and rely on them to take care of these steps. It's as simple as that. And that's the passive part of it. So what you're going to achieve, like the benefit for the next three items. Number one is typically there will be cash flow, and investors will receive a share of the net operating income, meaning all the rents and other income minus all the expenses. And then you're going to pay for the senior debt on the property, for pay down the loan, and the profits will be split among investors. Second benefit is appreciation. And as I mentioned in the prior slide, here we will look, and that's our main focus, our main business model. We look for value add properties, meaning that by either doing renovations or other improvements to the properties, or maybe streamlining the management and the expenses, we'll be able to add value by increasing the income. And the net operating income has a direct relationship with the value of the asset. So that's how you can force appreciation in that case. And finally, and I think that's for some people, it's a very valuable, we have investors who are looking at that side all the time, the tax benefits, because when you invest in a real estate asset, you're going to be able to depreciate this asset over time. And particularly when you go into commercial real estate, you can do a cost segregation and to accelerate the depreciation. And also, currently, there is still tax laws that were passed fairly recently where you can benefit of bonus depreciation. And the net effect of these tax benefits is that you're going to be able to write off any passive income that you receive thanks to the depreciation that is passed to the investors. You'll be able to write off any passive income that you receive on that tax year. So it's very valuable, and that would apply, again, talk to your CPA, but any passive income, I believe that would include, for instance, income made on stocks, but also certainly income made on other real estate investments. So again, if you have any question, I'm keeping an eye on the chat. Feel free to unmute yourself for a small group or ask the question in the chat. If there are no questions, I will move to the passive investors experience. I know there are a lot of bullet points, but it's pretty straightforward, I would say, process. And there are things that you have to do and things you have to be more active than the rest. I would say the first six bullets is where you're a little bit more involved. So first, you're going to vet the sponsor and the deal and look at the experience of the sponsor. Have they done this type of deal in the past or not? How many full turns or full cycle deals have they done? What kind of returns have they obtained? And also you want to look at the deal as well. I'm not saying necessarily to do the underwriting, but at least understand the parameters. And very often, if not always, you'll have access to a webinar where the sponsor is going to present not only their resume and show their experience, share their experience, but also what are the features of the deal, how's the market like, what's the business plan like, how they're going to achieve the value add. So if at that point, if you're interested and if you have not invested with that particular sponsor yet, you would create an account on the sponsor portal. And these days, I think any sponsor of some magnitude is going to have a portal. And several years ago, we didn't have, not everybody had a portal, but now it's very common, and it's very practical for as an investor to use and to have a repository of the information that you may look for down the road. On the portal, you're going to have access to all documents that are available, and typically there will be a private placement memorandum that is going to describe additional characteristics about the deal. And that's an SEC, Securities and Exchange Commission requirement, that the sponsor produce that document to be reviewed by investors. And also there will be an investor questionnaire, basically. That's the document that will have to be signed at step 5. But if you're satisfied with what you read in the private placement memorandum, as well as like the overall presentation of the deal, now you can soft commit and basically say to the sponsor, okay, what I've seen, I'm happy with what I've seen, and I'm ready to invest an amount of money. So that could range from 25, 50, 75,000, sometimes more, depending on the deal. The next step, you would sign the documents that I mentioned earlier, review the PPM, and sign the investor questionnaire and all the paperwork. There are additional details there, but it's pretty in a one package. Step 6 will be to wire funds. So they will share with you at that point the bank information to be able to wire funds. Sometimes I know we do offer actually for investors to do an ACH. So you save a little bit of money when you send the funds. And I'm sure you can do some checks as well. And then you wait until closing, and that's a little bit like you can wait a few weeks. But then there will be closing on the property. I know I didn't write it here, but it will be the next step. You would receive a notification about that, and followed by monthly or quarterly updates and financials that will be made available to you. In addition, you will be sent the distributions. That's what I mentioned on the prior slide. There will be distributions. Typically, distribution sometimes doesn't start right away, but usually there are some risk distributions between, it could be as low as 3%, but it can be as high as 10%. That's the range of what type of distributions to expect there. On yearly basis, you will receive tax documents. I think the due date is March 15th to make the tax documents available. Unfortunately, there are often events that lead to some delays on the tax documents. So the best is to ask the sponsor if they have an idea of what kind of returns are expected. So at least you can file your taxes and pay your taxes in due time and not have any penalty. And final step there is you will receive the proceeds of the capital event, being either it's going to be a refinance or the disposition, the sale of the asset. So that's what to expect as an investor. I'll give a sec if anybody has a question. If not, I will carry on to our last slide here. So what's the passive investors' worst case scenarios? Or what are the scenarios? Number one, loss of capital, because I think as any investment, there's a possibility, there's a risk of losing either some of your investment, and there's a risk of losing all of your investment. It's not unique to real estate. I think if you take the case of Enron several years back, that the stock went to zero. That happens sometimes. I think more recently there were these properties in Houston that went into foreclosure, like 3,000 units. Actually, we did a webinar a few months back about that. Again, it's something that happens sometimes, but I think that's where you certainly want to make sure that the sponsor has the experience and the infrastructure needed. So that was the kind of the conclusion of the analysis we spoke about during that webinar, to avoid any loss of capital. The next, which is obviously a little less critical, the delays or reductions in distributions. Maybe if the deal is going a little bit not, let's say you observe like higher vacancies than expected, or you have an increase in expenses or economic downturn, etc. I think the net result is going to be that the sponsor is going to say, look, we are going to either reduce or delay distributions in order to keep the capital available there to be able to sustain the adverse conditions for as long as possible. The next point to consider in a kind of worst case scenario is our operational issues. And I think it's a little bit, I think the result for the investor is going to be really the delays and reductions of distributions. But operational issues can range from poor management, maintenance issues. There could be legal or regulatory issues on this side, and that's something really we have to keep an eye out. Usually, though, legal and regulatory, that's something that's moving relatively slowly, so there's enough time to turn around and take the necessary actions. And again, what happened if we take the example of COVID as a kind of, some have called a black swan event, you never know what may happen. And so what we ended up doing is we suspended distributions because we started to face a lot of tenants who couldn't pay rent. So then we worked with tenants on payment plans. And eventually we went to the government to obtain some help as a small business. So that really was helpful to be able to carry on. So number 4, capital calls. I think this type of situation may happen if the business plan and the hypothesis you used, and maybe you used like a shorter term bridge loan at the beginning after the acquisition, with the expectation to be able to refinance year 3, for instance, after your renovations, but at a rate of 5%, which 2 years ago, it was a very reasonable expectation. But now the reality is quite different. We're looking at 8%. The net result is that you're going to end up having less proceeds from your refinance, and meaning that maybe based on the leverage you had initially, the lender is going to expect more equity, more down payment in order to do that refinance. One way to answer that is to ask all the investors to add additional capital in order to carry on with this refinance. Again, there are ways to work around that. And I think like the number one, and I think it's true for a lot of these things, but you want to make sure that there's sufficient reserves at the property to be able to handle any adverse situation. That's one key thing here. Make sure to look for reserves when you're assessing a deal. Market volatilities is next. I think here, like what we want to say is some markets are going to be more sensitive to changes. And what I have in mind particularly, I know being in Atlanta, all suddenly in 2021, for instance, I think that the rents exploded and they went 20% higher. And now there was like very strong demand on real estate, and people paid a lot at that point. It was probably unadvised to do that. But and now it's the rents being lower from what they've been a year ago, because when it went too high too fast, and now there's a little bit of a correction. right? So again, and if you put on the side the interest rate discussion we just had, if you have negative growth in rent, obviously people are going to be more conservative. Let's say the next buyer, and he's going to say, this is really what I think the property value is, which is right here. Whereas maybe your expectation, it was right here. So now you have a gap between where you can really sell the property at, because rents are coming down temporarily. So that's an effect of the volatility. So again, reserves, I would say, can help, because maybe you want to stay a little longer in the deal. And when that's where I have, when there's we always say 3 to 5 years for the hold. And sometimes it takes, you have to stay 6, 7 years in order to come back to market conditions that are better, more optimal for selling the property. Sponsor mismanagement, I think here is really the risk is obviously on the people who are managing the asset. There's always a risk that the sponsor is not being unscrupulous in how they manage the asset, and it could be a competence question, which is what I mentioned earlier. Make sure that you're going to vet the sponsor and check their experience and so on. And they could be like just lack integrity in how they manage the property, which is obviously now it becomes a different type of problem. I think the SEC particularly is doing a great job at, if you have basically a track record, any conviction or things of that nature, you won't be able to do that type of business. There's a bad boy clause on what you can do and cannot do in this type of investment. And finally, the lack of liquidity, and it's tied to, again, the other things. If you have operational issues, if you have a market volatility or things of that nature, and the risk is that you have to take care of paying your lender first, and you don't want to be in default. And from that standpoint, it's important to have reserves again. Reserves. So I think the solution for all of these risks, and again, like sponsor mismanagement, have a dishonest sponsor, it's a kind of a very different issue. But otherwise, making sure that you have reserves, making sure you have a strong team that has infrastructure, like the team in place to handle the operations, making sure that during the deal presentation that there's been a stress test, meaning that what if my occupancy drops to 70%? Can I pay the loan? Can I pay the mortgage on the property? Or do I lack liquidity? And then I need to do a capital call, right? That's the things that you should look for into. I'm a little bit distracted by some messages there. Thank you, Mark. I left already. So yeah, to recap, I think, and I'm going to add it here actually. Look for, so what did I say? Stress test. What was the last thing I mentioned? How does property perform percent occupancy? That's an example of the stress test. Reserves. That's another thing to look for. And I would say, if there is a variable interest rate, then look for a rate cap. Rate cap, meaning that will cap the interest rate to a certain number, and the situation where you don't have, your interest rate is just going to go wild and to any level that's uncontrolled, and then it becomes like very tough to pay to pay the mortgage on the property. Do you have any questions? Because I've reached the end of what I had. So in anything I didn't address, anything that was unclear, take that as a no. So before we move to the more interactive, and hopefully we'll have, I'm preparing you for that. If you want to unmute yourself, turn on your camera. If you want, we can get to know each other a little more. Usually, sometimes when we have larger groups, we do breakout rooms, but I don't think it's necessary, as we had some people who had to leave. So if you want to reach me via email, here's my email address, philippe@boostmycapital.com. My partner and the MC usually of the call is Jeff@boostmycapital.com, and our resident student is Rajiv. And again, Rajiv and Jeff couldn't attend tonight. So you can scan the QR code. I believe it will bring you to a webpage, an about webpage with our information as well. And our website is at the bottom here, boostmycapital.com. Anybody, any question? I'll stop the share. Yeah, we can move to the kind of networking part of the call. It's like if anybody wants to unmute themselves, introduce. I hate to call on you, so I'm looking for a volunteer here to tell us more who you are. Uriel.
Hello, good evening.
Hello. Did I pronounce
I'm
your
new.
Did I pronounce your
No,
first name? No? How do you pronounce it?
no, but it's fine. It's Uriel. It's like a French name, but it's fine.
Oh, Uriel. Oui, I can say it in French, I think.
Okay. Okay, thank you.
Are you French?
No, I'm from Central Africa, but we're colonized by French, so French is my primary language.
Okay. Me too.
Okay, nice to meet you.
Nice to meet you too, Uriel. So
So I've signed up.
go
I'm
ahead.
sorry, go ahead.
Oh,
I
no,
signed
yeah,
up for this group earlier this year, and life got along, and this evening I was like, okay, I need to see if they have anything going on, and I decided to join. So I'm not sure what usually goes on and what are the topic that usually discussed.
Okay. So yeah, our company is Boost Capital Group.
Mm-hmm.
So we're doing real estate investments, and that's this, as I mentioned earlier, our goal here is really to do part education, part networking for whomever is up to that. That's what we're doing. So what you're interested in real estate?
Yes, I have no background in real estate. I've been wanting to know more, and I felt like joining a group where, networking with people who have more knowledge will help me a little bit.
Okay.
I'm really like at the ABCD of level of real estate. I don't know anything about it. And the topic today was interesting. Looking at especially the part that I was more interested in is the lost that you were talking about. Because I do Airbnb. I have a little bit of Airbnb experience from the past, and it's really like you were talking about, be able to cover costs in case you don't make it.
Right.
You should be able to make sure you have the capital to do that. It's really what I've also experienced with my small background in Airbnb rental property.
Yeah, I think on Airbnb, one of the big risks that's out there is like regulation risk compared to other. It's more prevalent on Airbnb because we've heard like cities in the past that changed their regulation.
Exactly.
And that's very. So I have a former student who recently, because I'm doing some mentoring on multifamily actually, and he recently shifted gears and decided to go towards Airbnb, and he was saying like his goal is to buy an asset that would he would like just cover the cost of the loan if it was like just rented with no upside from the Airbnb, and then anything with Airbnb is above the line, which is, I think, some smart way to look at
Right.
it. Where are your Airbnbs at?
I have one in Dallas in the past that I did, and now I'm just doing a small one here in Atlanta as well. In the how do you call that area? Buckhead area.
In where's that you said?
Buckhead area. Atlanta in Buckhead,
Oh,
like close to
Buckhead.
Midtown.
Buckhead. Yeah.
Buckhead. Yeah.
Yeah. You have to come to our meetup then. Did you come to our meetup?
No, like I said, I joined earlier this year, and I've had so much going on, and yeah.
So
Whenever there is a meetup, I will
yeah,
definitely
well, because
make
that's actually we do our meetup in Buckhead.
Is it at the Iron something?
Yes,
Yeah,
Iron
I think I
Hill.
saw that. Yeah, Iron Hill. That's what I saw earlier this year.
Yeah. You have to come to
How
our.
often do you do the meetup?
We do it actually. So it's third Tuesday. Yes, third Tuesday of the month.
The Tuesday of the month.
Yeah.
Okay.
So we didn't announce. Actually, I have to work on creating the next event. The next
Tuesday,
event is going to take place not at Iron Hill. It will be a different location.
and you say Tuesday I won't be available, but that's fine though. I'm glad to meet virtually.
Tuesday, 6 to 9.
Okay. I might be able to join part of it.
So yeah, be on the lookout. I can post the. This is the post the link to our group. Like I said, I have to create the next event. So the next event is going to be not at Iron Hill. It will be a different location,
Okay.
and it will be a change of gear with a presenter, because usually what we've done so far is just networking.
Mm-hmm.
Yeah, we're shifting on that particular event. There's a group asked to work together on the next event. So the
Okay. Well,
lender.
thank you for your time that you do in presenting all this.
Yeah, but you definitely need to join on meetup.
I definitely I thought I was part of this group already. I think I'm part of the meetup group already. But I would definitely join one of the meetup in person, at least part of it on a Tuesday.
Yeah, so the next event is going to be at the sister restaurant in Buckhead. I don't know that place. And so the lender is Money Stream Financial Solutions. I don't know, we'll see. So we'll see. This is going to be interesting, I'm sure.
And you said that will be Tuesday. Which Tuesday?
The 17th.
The 17th.
17th.
Okay,
I can share my screen actually.
okay.
Yeah, I received information today actually. Who's going to be this gentleman is going to present.
Okay.
Michael Obit. She's another French sounding name. Dynamic Florida-based hard money commercial lending powerhouse. Yeah, it doesn't have an outline yet, but so I will update that. Yeah, he's working on it.
I look forward
So
to
fresh. And next, so the next months in November, we'll be back to Iron Hill for purely networking, as typically. So
Sounds good. Thank you for the information.
yeah, you're welcome. You're welcome. Want to say hello? Papa is busy. Papa is busy. So let me stop my share. We had a visitor just stepped away. I didn't have the opportunity to greet her. Milton, you want to share a little bit about yourself?
Sure. Hello, everyone. My name is Milton Bramble. I'm from Boston, Massachusetts. I'm in the planning stages of moving to Georgia within the next about 9 months or so, I'll say. And what I do is I'm an emerging small developer here in Boston. And I mostly develop the products I've worked on and developed have been multifamilies, mixed use buildings, commercial space on the ground floor, and residential living on 3 stories and above. Small acquisition of a 31 unit building, and also doing the asset management of the portfolio. What I do is it's in the affordable housing world. And so I'm looking to continue to do the affordable housing work when I move into the state of Georgia, particularly so far. What I'm been accustomed to or dealing with has been the Gwinnett Housing Authority in Lawrenceville, and I was working on a small project. It's not a small project, but I was working on a project in Lawrenceville. It's a senior housing, and I was doing some compliance with hiring minority subcontractors for the developer. So it was a HUD funded project. This developer in particular, I think it's One Street Residential. That's a developer, and the owners are the Gwinnett Housing Authority. So I'm looking to pretty much replicate what I do here in Boston in the Atlanta. Yep, go ahead.
Why are you moving to Atlanta?
Change of scenery. I'm gonna get a little personal. I've lived with my grandmother for my entire life. I'm 39 years of age, and she recently passed away about 4 months ago. And
I'm sorry for your loss.
Yeah, so it's been, thank you, appreciate that. So it's been quite a tough loss for my family and I. Again, she lived with us, and my wife and my children, and so we want a change of scenery. I do for the most part. I'm still going to actually be doing work here in Boston, but I'm trying to make Atlanta the base because I'm trying to move into a new situation and just completely break off on my own from this small development company I'm working with now. Just pretty much replicate what I'm doing here in the Georgia area, in the Atlanta area, trying to make some new impact and bring some different ways to the affordable housing community down there, as we do it a little bit different in Boston. I have some value add to bring.
Very interesting.
Yeah.
Yes,
So,
you'll have. You said how long you think you'll be here?
So what I do now is I come down once a month and I stay for about a week or so.
Oh, okay.
And I try to position myself around conferences and just meetups, and again trying to make my way.
Yeah, you'll have to come to our meetup then as well.
Yes, I'm looking at the one on the 17th that you posted, so I'm very interested, and I think I'm gonna make that meetup and come on down. What I'm trying to do mostly is what you got going on now, as far as finding new partners, financial partners. I met with a lending company, a private lending company today called Crowd Lending, and they do some okay things, but their market is the New England market, so they wouldn't be a good partner for what I'm trying to do as far as acquisition in Georgia. So my goal in Georgia is to, again, pretty much do what I'm doing now in the affordable lane, and also I'm pushing in the direction of learning the light tech and tax credit deals. What I would like to do in Georgia as well is acquire apartment buildings to rehab them and turn the property into something different. Not in the affordable arena where you go for the Section 8 vouchers from different voucher subsidies.
Mm-hmm.
But yeah, I want to try something new. And I feel in Georgia, the state of Georgia is a place I love. So that's one of the reasons why I want to make a shift down there as well, because I travel there so often. And at one point, my children used to live in Georgia. Yeah, I'm a little familiar with Georgia, not deeply rooted or anything like that, but I'm looking for a change of scenery, and so is my family. So yeah, I'll definitely be at that meetup on the 17th.
Yeah, please come. Yeah, absolutely. Yeah, looking forward to meeting you. Myself moved here early 2021. I
Okay.
used to live in northern New Jersey,
Okay.
and I had W-2 at the time, doing totally different occupation. I was working in business jets and started to do some real estate on the side. And one thing led to another. I'm doing this full time now.
So you said you were working with business jets. You were working in FBO.
I was working for a manufacturer actually of jets.
I worked in aviation as well before I got into real
Oh yeah,
estate.
for Dassault Falcon Jet.
Okay. So you were doing with business jets. I worked for general aviation. So aviation was my thing before I got into real estate.
Okay.
So aviation, I worked for General Electric. So I used to build T700 and CF34 and 414 engines assembly. So I was a production manager and managed the line and all the parts to get to the different military bases that we served.
Interesting.
And then I worked in general aviation. I worked in FBO, fixed base operation. So I was a duty manager, which pretty much just ran the tarmac or pretty much the operation. So from the main point of business with them was to selling jet fuel. So to the business.
Okay. Yeah.
Servicing a business jet. So pretty interesting occupation. I actually liked it.
Yeah, no, me too. But yeah, it was time to make a change.
Yeah, time to make a change. You don't make no real money unless you're there.
Yeah, exactly.
I want to be flying on the plane, not parking the plane.
Yeah,
but yeah, I'm very excited to start again, make this move down here. And like I said, I'm starting my networking early. Like I said, see where I can create joint ventures. I've been speaking with I've just recently started speaking with the community development manager with the Gwinnett Housing Authority. So I'm poking my way around slowly. I don't want to come in hot. I want to be the newcomer that's patient and observant. So I don't make so many mistakes.
No, that's very interesting. Very interesting. Yeah, that's a different. I remember looking at light tech deals at some point. It's not. I like to stick to what I've learned, but yeah, it's a little bit of a different nuances for sure.
It's now with the development that I do. It's like I said, most of it is state funded or federally funded. So there's a ton of red tape, right, that you have to deal with when it comes to HUD. So I have all this HUD training and all this HUD stuff that's underneath me.
So do they bring the equity as well, or just the lending part?
No, they bring a lot of liquidity because of the tax breaks that you're gonna see.
Yeah, but like from an equity standpoint, where do you find the equity? Who is investing?
Oh, equity standpoint, I gotta be right now from an equity standpoint. So there is. I'm gonna just tell you how the deal was done. So it was a $7 million acquisition, and the city of Boston contacted me and says, "Hey, we have a program. It's called the AOPs, Acquisition Opportunity something. I forget what the P stands for." And basically, they wanted us to go out, developers to go out and find 20 unit plus buildings, and they was going to help us acquire those buildings. As we're in a crisis up here for affordable housing for AMI. Right. Blah, blah. So they said, "Hey, we're gonna give you about $2.5 to $2.6 million on the acquisition." So I went out, I searched for about 6 months and not one building for sale. And just when I was giving up, a good realtor friend of mine pops across and says, "Hey, I think I got what you're looking for." And it was literally about 3 or 4 blocks up from where I reside. And I went to check out the building. And I looked at it, and it was an F- of a building. But the gross potential rent on it was $50K a month, again, in 31 units. So he said, "Okay, I know I probably could stabilize this building in about maybe between 3 to 5 years, I could stabilize the building." And so far, so let me back up a little bit. So we acquired the building. They gave us $2.6 million. We asked for a loan for 7.5 because we overbid. We paid 7.1. So we figured the 400,000 we could keep in reserves to start doing some of the renovations that we planned on doing. And then another friend of ours came in and says, "Hey, won't you get in, do a light tech deal with this building?" And we're like, "What the hell is a light tech deal?" And so we started doing some research on the light tech, and this building in particular fits the exact criteria for a light tech deal. So we're going to try to flip the building to a light tech deal. We're going to go do our research and homeworks before we get into or try to get into a live tech deal. So it's just
Mhm.
another partner of mine. We just small company.
That's interesting.
Yeah, I'm trying with the way the market is now. I'm just trying to get creative with.
Yeah, I've never. It's the first time I hear this type of. This is very out of the box. From what
I'm
what
thinking
we're
out the
doing.
box right now, man. Because
Very interesting. I'm right here in Lawrenceville, actually. I'm in
oh,
Gwinnett
you're in
County.
Lawrenceville.
Yeah.
Oh, that's even. This is exactly where I'm looking to locate.
Yeah, I used to live in Duluth. Now I moved to south of Lawrenceville, close to Snellville. That's where I am.
That's
Right
not
now.
where my kids used to live. My kids used to live right in South Lawrenceville. They are right. It was close to Dunwoody, but it was off of Sugarloaf Highway or Parkway or something like that.
Yeah. Yeah, I'm in that area. It's not far. It's 10 miles maximum. Yeah.
Yeah, I really like that. I like the Lawrenceville, Gwinnett County. It's really it's very peaceful, and that's what I'm looking for. I need peace. I'm a city guy. I want peace, and just to be able to think. I just like the way of life how it is in Georgia compared to up north. It's just things are so fast up here. It just zoom, zoom, zoom.
Well,
zoom.
you spend enough time on the highway here. That's not very different from up north. Like, this is crazy. This is nuts, the traffic.
What's interesting, like I said, I'm there pretty often, so I get the traffic thing. You're from Jersey, so the city life, let me put it this way. I work literally in the neighborhood where we build everything. So I can literally walk to every property that we have in less than 10-minute walks from each property. And between the properties, we have what, 1, 2, 3, 4. So it's 5 properties, and I can literally walk to all 5 properties. And we systematically designed it in that way. As I was, again, the asset management piece was my piece to say, listen, we need to develop in a place where we can get to everything. Time is money when we're dealing with multiple situations. When it comes to maintenance and operation, those are the things I always think of, the logistics of the property. I don't want the property that I'm managing or running or developing or building to be lean. I want them to be robust. I don't want
absolutely. I'm with you.
I'm facing a lot of leanness right now because of some vacancies. Well, to be quite honest, out of the 51 units that's currently built, we only have 3 vacancies. So 2 1-bedrooms and 1 studio out of the 51 units. Literally just completed a 29-unit building that's going to be added on to this portfolio. But we're waiting for our certificate of occupancy. We're getting our certificate of occupancy about next week.
That's pretty good. I know
we're rocking and rolling.
I have a property in Memphis, Tennessee. We're at 80% occupancy right now.
80%. Okay.
Yeah, it's been tough. I think the Memphis market's not doing that great.
Okay. Yeah, I'm very blind towards the southern market. So that's what I'm trying to come learn a little bit to see where I can actually create some impact or create the value, add some value.
Yeah. But like you said, if you're looking at totally different kind of business models, if you're working with some housing authority and whatnot, like to do developments and etc. So that's a great, if they have a budget, that's the way to do it.
Yeah, and like I said, if you go out right now and you buy for instance, I have a client that came to me recently, like in the last 2 days, and there's a parcel, it's about 3,500 square feet. So they look up north, we do a lot of triple deckers up here, right? And I looked at the cost of what it was going to cost to build right now. I said, okay, if you put up a three-story building, 3-bed, 2 baths, maybe about 950 square feet. To build that, it's going to cost you probably about 1.1 to build that. Now, if you want to hold that for the long term, it's great. You just gotta let the life of the building come to play in about 5 years, try to get it stable. But the risk that I see in that, even if you have voucher tenants or Section 8 tenants in your space, there's always a risk, right, of something not going through the subsidy. So there's got to be some reserves in your space, in your operating account, in case the subsidy stops. I'm facing that right now with 18 tenants, and that's equal up to $88,000. But hopefully, they said we were supposed to get paid on the 1st. I'm going to be calm. We'll wait on the 1st, but from an asset management standpoint and from a management standpoint and a development standpoint. Right now, it is tough to build. So again, now I'm trying to find different ways to be creative with the financing, because obviously we know the rates are just too high to leave any meat on the bones right now for anybody.
Yeah, but if you do a HUD loan, maybe that's probably the best option in that case. I guess for development that doesn't necessarily work, but like for multifamily in place, you can do a HUD loan. Those are best terms.
Yeah, and that was one of the reasons why I went to talk with these lenders today. They're like, yeah, we could fund the deal. It's going to be, they're pretty nice about their deals. They're 10% down, 3 points. And yeah, they're going to give you 12 months to get them paying back. And again, as an investor, yeah, it's still a good time to build. If you don't have to acquire the parcel, if you own the land, it's a hell of a time to build. You can pull equity from the land and get going and go get into a construction loan from a hard money lender or something like that. So again, just trying to find creative ways to keep the pot moving here. And
my daughters are coming to pick me up.
Oh, nice.
Yeah, we're already past 8.
Oh, sorry.
It was a great conversation. Like looking forward to meeting you at our next event, Milton, and in future events as well.
Absolutely.
You too. Yeah.
Absolutely. We'll try to make it.
All right. Have a good evening, everybody. Thank you for coming, for joining us, and see you soon.
All right. See you next week.
Soon.
Thank you.
Thank
Bye-bye.
you. Bye-bye.